Hi everyone, it's Kim Adams. Happy Monday. And today on Money Talk Monday, I thought that I would kind of leave it open for some Q&A today. I do have some topics if there aren't too many questions, just to give you some tips and things that you might want to know, especially this time of year since it's getting to be tax time. And you may have seen on the news, they're talking about the increase in fraud with people trying to steal your identity and then, getting your refund. And it happened last year also, but it seems like it's even on the rise this year. So, hi Carol. She's open for tips. Good. Ask your questions too. So the first thing I was going to talk about was you may want to file earlier this year to avoid all of the fraud they're talking about at the IRS. Kind of scary, and I have heard of people where that's happened to them. So the recommendations are to file early, to never give your Social Security number or anything private like that out. The IRS and most states will never email you or even call you. Most of the communication with the government, especially with respect to your taxes, is done via mail, snail mail. There are a few states. When I was still in the tax field a few years ago, there were a few states that would email us as practitioners. I don't know if they were actually emailing taxpayers, but you can be assured and be suspicious. I should say you should be suspicious if you get a call or an email from any taxing authority, whether it's the IRS or a state government. They normally don't do that. So don't give your personal information out, and file as early as possible, because I think that helps to prevent it and gives more time for an investigation. It sounds like, though, that one woman that I saw on the news said that even though she was having this problem, there were no resources at the police level to even investigate it or to even prosecute and try to find someone. So that's a good question, Carol. If your CPA files the, do you have to worry if, just because your CPA is filing it doesn't mean that you might not accidentally give out information that you're not supposed to. So the CPA will be filing the return, most likely e-filing it through the software they're using at the firm. But what happens is, even when they file it in the appropriate way, if by some chance you do something separate from that to give information out, someone can just take that and run with it and then try to log into your account and grab the refund. So no, it's not a foolproof method to have your CPA file the return. So just be wary, like with anything. You're not giving out personal information. Shred anything that comes in the mail that has, the full account number on it or your social. Don't put that in the trash. I was surprised the other day. I had a credit card statement and they had the full entire account number on there. So many just put the last four digits of the account number, but this particular card had the full account number. So I always save those statements. I thought I had opted for electronic statements, so I'll have to double check that. But so I shred all of those. So anything that has your information on it. So not foolproof, unfortunately. And I also had written a blog post recently, so I thought I would just highlight some of the things I talked in there about the three tax deductions that every business owner should be taking. And so I'll go over those. The first one, first and foremost, is if you are not contributing to your retirement in some way. There are lots of options for self-employed people that have businesses. So if you're employed and you have a 401k, that's typically the retirement plan that most employees have. But there are comparable and equivalent types of programs for self-employed people. There's something called an individual 401k, or an individual 401k that someone with a business would do. So it's not an employee type 401k, but it's a similar kind of thing. There's also a self-employment plan called a SEP. So there's all kinds of ways that you can save for retirement, get a deduction for it in your tax return. So I highly recommend that. Defined benefit plans, what we used to envision as the traditional pension plan if you're employed those have gone by the wayside. So it really is more, the responsibility is more on you to save for retirement. And the best way to do that is to save and get a deduction for it. Really cool. Okay, let me see what Carol's question is. Should I pay off all my debt before I invest into my retirement? If not, how to determine allocation to both? Carol, that can't really answer that without looking at your particulars. It's a good question, though, because a lot of people do have a lot of debt. And it's not that, and it's hard to answer that because I don't have your particular information. But the problem with credit card debt, if it's credit card debt, is that they're so high as far as interest rate. So the trap many people fall into with that is they're making payments on the credit card every month. But first of all, if they're still using the card, the balance is going up. And the balance is going up regardless because the interest is so high, it's being tacked onto the balance. So sometimes that's the trap you can get into. And it really, you end up paying so much more than you would because the interest rate's so high. So depending on how much debt you had, the interest rate it's at, I might, have you focus on really paying that off first before you start investing in your retirement. But if you're in your 50s, if you're later, if you're saving later in life, 40s, 50s, you might want to start doing it now because the benefit of saving for retirement is that you most likely will get a tax deduction for it. And so the benefit of that is that you're saving taxes on it, which is a big deal because then that can actually help you increase what you're putting into the retirement money, right, or into the retirement fund. So let's say, for example, if you're normally, let's say, over the course of a year, let's say you want to contribute to your retirement and you want to put $4,000 in, but you save $1,000 in taxes. By doing that, that might help you put in more. Invest $5,000 and save $1,000 or save $1,500 or whatever. So it actually helps you increase the amount you can put away because of the tax savings. And tax savings and compounding are two of the biggest wealth building tools you have. So any way that you can save taxes in the current, in the present time is really a typical tax saving recommendation. But I'm not, this is kind of general information, so I'm not really giving advice because I can't do that without your particular situation. But it is kind of it depends on a bunch of different things. So anyway, if you are self-employed or have a business of some sort, whether it's in a subchapter S, a C Corp, a partnership, LLC, single member LLC is actually treated as a sole proprietor for tax purposes at the federal level. Just save for your retirement because it's a benefit, it's a tax deduction, and you need to do it anyway, right? We're on our own for retirement pretty much. Okay, the second thing that business owners should deduct, and this applies if you have children under the age of 18 or under the age of 21. There's some different rules depending on what age the kids are. But this is an awesome way to accomplish several things. Kill two birds with one stone. So first of all, you can teach your kids about business, right? You can pay them a salary. You can pay them wages. You get a tax deduction for it. And in turn, they are receiving earned income, which actually qualifies them to contribute to an individual retirement account, an IRA. And that is pretty awesome. So if I've talked about compounding before, the earlier you start, the better. So you can set your child up at either having them contribute to the IRA or you can actually contribute on their behalf. It doesn't matter. Just so they have earned income. You have to have earned income in order to contribute to an IRA. But you can actually start your child pretty early. So paying your kids for activities in your business is really pretty cool. There's certain restrictions though. If you're a C Corp, there's certain entity requirements that have to be met in order for you to do this. But if you're a sole proprietor, if you haven't really created any type of entity, or you're a single member LLC, meaning you've got an LLC, but you're the only one in it. That's a single member LLC. And for tax purposes, you're treated as a sole proprietor. So you're just filing a Schedule C with your tax return, just like, someone that hasn't done anything as far as creating an entity is doing. So if you're doing that, you can actually hire your kids. So lots of benefits. The money's staying within the family. You're getting a tax deduction against the business income. It's helping your child earn money, but also have earned income for purposes of contributing to an IRA. It's pretty powerful. And there's always things we can give our kids. One of my friends just hired her 13-year-old to do paperwork and to do some things that she had to put these packets together, these marketing packets together. So there's lots of ways that you can have kids help you. And heck, when it comes to social media, they're more they're more knowledgeable and faster on any technology than I am. So there's lots of things kids can do. They can file for you. They can, if you trust them, they can answer phones. They can do some filing. They can clean your office. They can post on social media. What else could they do? Posting on social media is really great. That's a really good idea. Have them do some of that stuff. The third thing that I don't think a lot of business owners take advantage of, but I wanted to mention that any type of personal growth and development that you're doing, so whether like business coaching, for example, or seminars you're going to, are all tax deductible. So if someone's quoting you a price, maybe you're hiring a business coach and they're quoting you a price, just realize it's really less than that because of the tax savings. So if you're paying a coach $1,000 a month for business coaching, depending on your tax bracket, the tax benefit reduces the cost, the actual cost of that program. So if you're in a 25% tax bracket overall, you're really only spending $750 because 25% of $1,000 is $250. $250 is the tax benefit, so that's what you're saving. So I wanted to make sure you understand that. And really investing in yourself is such a necessary thing when you're a business owner. As an entrepreneur, business owner, you're always growing. So having a business and personal growth and development they're not mutually exclusive. They're exactly the same thing. So if you're not growing as a person, you're not going to grow your business, just the way it is. So anyway, just realizing that investing in yourself is also a tax deduction. How nice is that, right? Business coaching is tax deductible. Seminars you go to. So invest in yourself, invest in your training, invest in your employees and your team's training. It's all tax deductible. Let's see. Any other questions anyone has? I'm just getting ready to I pulled all my tax information together. I'm getting ready to do it pretty soon here too, before it gets too close to the deadline. Thanks for being here, Carol. You're always so loyal. I appreciate you. We have our mastermind call on Wednesday too. So what else can I tell you about taxes or accounting or record keeping? Record keeping, I've talked about this before. You don't have to learn QuickBooks. That's a misnomer. That's a myth that a lot of business owners think they have to learn QuickBooks. No, you're adding a bunch of complexity and stuff you don't need to learn. You are fine with just organizing it. Your accountant just needs you to organize it, especially if you are handing your stuff over to a CPA or a tax preparer. You don't have to learn QuickBooks. Just give it to them in an organized manner. They can help you figure out a plan that's easiest for you. So don't feel like you have to learn all the ins and outs of QuickBooks and accounting. That's a whole area that you don't need to stress yourself out about. Just worry about building your own business and leave all that stuff to the accountant. I've used an Excel sheet for years. It's worked just fine for me. I download transactions from my bank, credit card company. I sort it myself because I know what category to put it in. So it's worked for me for years. So I wanted to mention that too. Record keeping does not have to be that complex and difficult. Just wanted you to realize that. All right, I don't see any other questions, but thank you so much, Carol, for asking yours, and I appreciate you. So please, if you're watching this after the fact, just type in your comments below. I'd be happy to answer any questions if you have any. And if I don't have any more, I will talk to you guys next week or sooner. Take care. Have a great rest of the Monday and a great week. Thanks. Bye.